Getting the right mortgage can save you thousands or even tens of thousands of dollars throughout the lifetime of the loan. Understanding key details and what questions to ask is important when making such a big financial decision. In today's video, I'm going to be guiding you through the essentials of mortgages, breaking them down step by step. And be sure to grab the free PDF that I created that has all the questions you'll need to ask your mortgage specialist to ensure that you get the right mortgage for your specific situation. Link is in the description. Let's get started. A mortgage is just a loan for buying property, where the property itself acts as the collateral for the loan. Because the property is the collateral, the bank will need to verify that they can get their money back out of the property in the event of a default. This means that even though you're pre-approved for a certain amount, you can't go buy any property for that amount. With that said, getting pre-approved is still the first step. It shows you what you can realistically afford and makes you a more attractive buyer. Mortgage brokers can shop you around to different lenders and can sometimes get better rates or terms, where banks might be more suited for people with complex financing, like if you're self-employed. When getting pre-approved, make sure you bring your documents like proof of income, tax returns, and your job letter. I have made a video specifically on getting pre-approved, what documents you need, and where to find them. The link is in the description. There are two main types of loans. There's conventional and insured. If you're putting 20% or more down, you'll get a conventional mortgage, whereas if you're putting less than 20%, you'll get an insured mortgage. This insurance is for the lender and helps protect them against default. You might end up with a slightly lower rate if you have an insured mortgage. However, any savings will be offset by the cost of the insurance. If you put more money down, like 15% as opposed to 5, you will save money on the cost of insurance, ultimately saving you money in the long run. Amortization is the total length of time it takes you to pay off the loan, typically 25 to 30 years. The longer the amortization, the lower the monthly payment, but the more you'll pay in interest. If you're putting less than 20% down, you're typically limited to a 25-year amortization period, unless you're a first-time homebuyer, in which case you can extend that to 30. Mortgage terms, on the other hand, define how long your conditions and your rate will last, typically 1 to 5 years. After your term is up, you'll need to renegotiate a new term. Fixed rates stay the same throughout the term. They offer stability and help protect you against rising interest rates. Variable rates, on the other hand, are tied to the prime rate. They're often lower than fixed rates. However, if the prime rate moves, so does your rate. There are two types of variable rates. There's an adjustable and a static payment. The adjustable moves with the prime rate, so if that rate goes up, your payment goes up right away. Where a static payment remains the same, however, your amortization period will either get longer or shorter depending on what the prime rate does. Your down payment depends on the purchase price of the property. For homes under 1.5 million, the minimum down payment is 5% on the first 500,000, 10% on the portion between 500,000 up to 1.5 million. For properties over 1.5 million, it's a flat 20%. Also, make sure you budget for closing costs. A good rule of thumb is 1.5 to 4% of the purchase price of the property. If you want to look at closing costs in more detail, I have made a video specifically on this topic, which you can find on my YouTube channel. You can choose to pay your mortgage monthly, semi-monthly, bi-weekly, or weekly. The frequency doesn't really matter that much. It mostly comes down to personal preference. However, there's also accelerated payments. With accelerated payments, you pay a little bit more each period. Ultimately, you end up paying the equivalent of 13 monthly payments throughout the year. And with accelerated payments, you can save yourself tens of thousands of dollars in interest and pay your mortgage off years earlier. When shopping around for your mortgage, there are a few questions that you should make sure you ask your lender, including, what are the penalties for getting out of my mortgage early? Can I make extra payments without penalty? And is the mortgage portable if I move? Make sure to check out the PDF in the description that I mentioned earlier, as it has all the questions you'll need to ask to make sure you're protected and that you know what you're getting yourself into. So, to recap, understanding mortgage basics is important to making smarter decisions and setting yourself up for success. Make sure to take the time to compare different packages to make sure that you get the right mortgage for your specific situation. That's all for today. I hope that you found this video helpful. If you did, do me a favor and give the video a thumbs up, and consider subscribing to my YouTube channel for more real estate related advice. If you have any questions, please feel free to throw them in the comment section below or reach out to me directly, and I'd be happy to go over things with you in more detail. I appreciate you taking the time, and I'll catch you on the next one.